So good afternoon, everyone. Welcome to the third installment of the NITheCS Mini-school on Introduction to Quantitative Finance. It's a pleasure again to welcome Dr. Mesias Alfeus, who already gave us two great lectures on the subject. And today he will continue as planned with the introduction to quantitative finance. Yeah, Ms. Mesias will just in a second announce a slight change in the program, and we hope that you will all be able to agree with that. Yeah, but Mesias, I'm very happy to give you the floor now, and you're already sharing your screen. You're most and welcome to start. And the participant, the usual rules apply. Please use the Q&A to ask questions. And at the end of the lecture, if you want to ask a question in person, just raise your virtual hand and we can give you the right to speak. Excellent. So Mesias, please, over to you.
Yeah. Thank you very much, Francesco, for the opportunity again to continue my lectures on Introduction to Quantitative Finance. And thank you very much to all the attendees for making time and to come and learn or journey together on some of the important topics in quantitative finance. Before we continue, just like what Professor Francesco Petrocchion have alluded to, I have a quick announcement to make. So next week, we're supposed to do lecture 4, which is the final lecture on this journey of introduction to quantitative finance. But however, I'll be attending a conference in mathematical finance at Kruger National Park next week. So I decided to do the 4th lecture today after 3 o'clock. So this hour is going to be a double. This lecture is going to be a double lecture covering this week as well as next week lecture, if that's not a problem to you. But if you feel like you have other commitment at 3 o'clock, you can always go and watch the lectures on YouTube or channel for the NITheCS. I think that should be fine. I think those are the only announcements I do have. And thanks again for those who just came in now for making time and come and enjoy this subject with me. Yes. Just a recap of where we are and what we've done, and then what we're going to do today. Of course, this is an introduction to quantitative finance, which means is sort of like mathematical finance. So we started with introduction to derivative securities. These are financial instruments whose values are derived from another value of an underlying security, or which we call it is a basic security. So we introduced the most popular financial derivatives. We introduced the concept of no arbitrage and how to value these derivative securities. And these derivative securities, we said they are used for hedging, speculation, as well as for some of the agents that are commonly in the financial market, which are called the arbitrages. So, and now what we mainly interested in, especially when we look at the types of derivatives that we have also discussed, we say that we have futures and forwards. In particular, we discuss more on the future contract. That means you are standing to right today, you agree in that in the futures you are going to buy an underlying asset or you're going to sell an underlying asset. So now that means you are obliged to make sure that at future days, say capital T, you are obliged to buy or sell that underlying security. So, and then we discuss now different ways of pricing the futures by using no arbitrage strategy, by using no arbitrage principles, as well as we also discuss what we call the actuarial pricing and how actuarial pricing can go wrong or can fail by just looking at simple example of a forward contract. So today we're going to continue and look at what are the investment strategies, and also now look at the key principle of no arbitrage. Okay, so in the first lecture that we discussed 2 weeks ago, we have introduced what we call the law of one price, and this is also going to play a key role, especially when you're going to look at arbitrage pricing in the next lecture, which is going to be at 3 o'clock. Okay, so we just keep what we have covered already, and then we go to what we're going to continue for this lecture. Okay, so we call this is investment strategies. An investment strategy is a specification of what we call sort of like you have units. So you invest some sort of weight, which you call phi A times T, and this phi has phi 0 up to say n. So you have made say n investment or n plus 1 investment, where the phi 0 we normally say is an investment in a cash position or what we call in a bank account. And at time 0, so the basic security in here, the basic security is normally the bank account, and then we normally say the value at time 0 of that bank account is equal to 1, and normally that's why, but we're going to explain it later. So now you are standing at time 0, and then you have up to time capital T for your investment or your holding period. And like we said here, is your time capital T is the lifetime of the strategy. And then the value at any instant time T, given this investment strategy, is given the sum of all your investment, which means is phi is the weight at time T of investment in the security S plus the investment at time 0, what to keep it in a bank account. So this is your value at any time capital T. So the strategy in this way or in this form is what we call now the static, if and only if the holding does not depend on time. That means your weight must be equal to your weight of investment at time T is equal to the weight at position 0. So now in that case, we call it is a starting or is a static strategy. Okay, well, now the profit, if you want to realize the profit at times at any particular during the holding period, and the profit now in this case is going to be the value at capital T minus the initial value. So for static strategy, the value must now be equal to, you just sum. You take a sum of this, meaning it's a sum, this a function of your investment. Then you subtract S, you say ST minus what you have started with, which is mean S at time 0. Or what we call is a capital gain, your profit or your profit of that strategy. Okay, now to compare the gain of different strategy in a meaningful way, you require a non-anticipative, which means it's an adaptive process. So now in this case, you look at phi at time T, which means is a constituent of this phi 0 up to phi n for all this instant time small t. So what you call now in this case, you can buy and hold a portfolio, and then you determine the value at time small t equal to 0. So that means that because phi t only depend on the information which is contained in your filtration. Also, we discussed this on the last week lecture, and then we say this process here or this trading strategy is non-anticipative or is adapted to this fluctuation, because this fluctuation contains all information about this trading strategy. Okay, well, again, these are a few concepts that I just want to remind you of. When is the process adapted to the fluctuation, or when is the process called a portfolio called a self-financing portfolio? A self-financing portfolio is a portfolio in which the gain, the losses, or the gain is realized within the portfolio, meaning you're not going to borrow some money from, say, a bank account or in order to be able to top up in the portfolio, but everything is realized within the portfolio itself. Meaning the change in the portfolio value are only due to the capital gain, or meaning the change in the value of the asset, meaning there is no borrowing of funds from anywhere else. The change in the portfolio is being catered for by the gain or the capital gains of the asset itself. Okay, another way to define what we call the self-financing portfolio is that no funds are injected or taken out of the portfolio. And then in that case, these types of trading strategy is called a self-financing portfolio or strategy. And it will also play a key role in the next discussion. Just please take note of this. Okay, well, again, last week, if you can recall, we discussed the market scenarios, because here you work with random event or uncertain event, and then you look at a market scenarios, which we call omega, which is contained in the set of all market scenarios, and which is an element of this probability space. The probability space we also discussed last week, and it actually contains all the market scenarios, the collection of all the market scenarios, as well as the probability that assign the probability to the events if it happened or not. Okay, well, now, in here for now, let's just talk about investment strategies. So the phi and C, these are investment strategy, are two investment strategies. Phi and C, those, it depends on how much are you invest. So suppose you have funds, and then you want to make sure that you split this into different portfolio. Perhaps you putting some money in the stocks, in foreign, maybe cryptocurrency, or maybe put it in a bank account. It constitutes what are your weights, how much are you going to invest in each of these portfolios. So now, suppose now you have two self-financing strategies. Again, this is the concept that you please have to take note what it means by a self-financing strategy. And then we say that phi dominates C if they have the same value at the starting point, but at the final value, at the final time, at the final holding period, the value of phi is bigger than the value from the strategy C. And also it's given that the probability of the value C, or of the value of phi strategy bigger than the value of this strategy C is always bigger. And in that case, if this condition are satisfied, then we say that phi dominates C, meaning the strategy or the investment strategy phi dominates the strategy C. Okay, and again, this is just a definition. And then we then now continue but please take note of this definition because they will come up in the next discussion as well, because we are building on toward a certain key features of quantitative strategies. And then we talk about the arbitrage strategy. The arbitrage strategy in a nutshell will introduce from the first lecture that is a strategy that requires no initial capital, but at the end of the holding period or the investment period, you end up with some cash. It's like you just wake up, you have no investment in any bank. You wake up with them telling you that there is 1 million in the bank account for you. You have, yeah, it's an purely arbitrage strategy. Okay, well, then now we look at more formal definition of an arbitrage strategy from the mathematical finance point of view. So if you have two strategies, phi and C, then let's consider the new strategy that consists of buying phi and then selling these two. So you buying one strategy and then also selling the other strategy because you want to make sure that you profit from the difference in the pricing. So now the value of this strategy, which means it has a payoff, the payoff is now given like this because you are buying, you have this one, and then you are selling this one. That's why you have the payoff is now going to be what you have minus what you have sold. Now, in this way, you say the arbitrage strategy on a time horizon, which means that from 0 up to capital T, is a self-financing strategy, eta, such that you have no initial capital, you didn't put any money. The terminal value is always positive, and you have a strictly positive probability of making profit, or what we call making a riskless profit with positive probability, and that is a purely arbitrage strategy. Again, if you go through again, you require no capital contribution. You are guaranteed that you have a positive terminal value, and the probability of you making a profit is strictly positive. And that is what we call the arbitrage strategy. Okay, now the principle of absence of arbitrage strategy, it means that this is what again we introduced in the first lecture, that it says that in financial econometric or financial mathematics, we say that there is no arbitrage opportunity, and all the mathematical equations that are in most of the standard textbooks for quantitative or mathematical finance, they are derived from the principle of absence of arbitrage strategy. So this principle states that in a financial market, arbitrage strategy does not or do not exist, meaning there is no self-financing strategy such that you have no initial capital, you are guaranteed a positive terminal worth, and also strictly positive probability. There's nothing like that, such that this one here, especially that phi dominates C, and if and only if. So that means if this condition, that means if phi cannot dominate C, that means if these two have the same initial value, if these two strategies have the same initial values, and we are guaranteed that phi has more terminal worth than that, then this cannot happen then this cannot happen. So this is also from the law of one price that we also heading to, that if you have two portfolios that have the same initial value, for there not to be arbitrage, these two portfolios must have the same initial value. Okay, then we come to arbitrage inequality, and this is what we're going to go through and maybe prove some of these inequalities that play a key role in the financial market. So suppose you have two investment strategies, phi and C, as two self-financing strategies in an arbitrage-free market. You are given that the value, the terminal value of this strategy phi is bigger or equal to the terminal value of the strategy C. That means the probability of this value from phi will be bigger than value is almost surely. Then in this case, if you have that this phi has a bigger terminal worth, then the investment from strategy C, then you are guaranteed that the initial value from phi must also be bigger than the initial value from C. Okay, and again, I'll elaborate this more. It means that if you have two strategies, given that these two strategies, one has a bigger value at the maturity or at the end of the investment period, then for there not to be arbitrage, the initial value for the one investment which has a bigger terminal worth must be bigger than the initial value from the other investment strategy or the self-financing strategy. In particular, if the payoff is a price at any time before maturity of a derivative contract with a payoff at maturity, then for any self-financing portfolio, say phi, then we are given that if the value is bigger than the payoff, then we implies that the value at any time, at any arbitrage time, arbitral time, say small t, must be bigger or equal to the payoff at any instant time t. Then we say that strategy is said to be hedged, or what we call, in this case, is now what we call the super hedge of the derivative contract, or the derivative contract, which is normally denoted by H, which is the payoff of that. So now if the seller of a derivative invests according to strategy, say phi, at the expiry, he or she will have enough to pay for the holder of the derivatives because this is bigger. Okay, and now what we want to do, because this is something that, how do you, if you know that you have two self-financing portfolios, say phi and C, that you are given that the value for the strategy phi at maturity is bigger than the value of the strategy C at maturity, you are guaranteed that the value at any instant time or at any arbitral time t must be bigger for this trading strategy, must be bigger than that. Otherwise, there will be arbitrage. So this is what we have to prove. How do you prove this? So you prove by contradiction. So you assume that this one here is less than that, and then you go through so that, okay, so you assume that at any instant time, small t or small t0, this value here is less than the value from the strategy C. Then what you can do, in the financial market, so what you do, you always buy which is cheaper, and then you sell what is more expensive, and That's the intuition, right? So that means at this small time t, you buy this strategy phi because it's cheaper, and then you sell this strategy C at that particular time t0, and then in this case you realize a profit because this one is bigger, it brings you more money, and this is lesser, and then it gives you the value C, which is your profit, and this is positive. This is positive simply because this one is bigger than that. And then what you do, you buy a zero coupon bond with a maturity capital T. What does it mean when you buy a zero coupon bond? That means you're going only to pay back the notional amount at that particular, the notional amount in this case. You buy a zero coupon bond with a notional amount, which is C over D, T, meaning the discount factor of a time T for maturity T. That means if you take a present value of this, if you take a present value of this, that means you multiply by D, T and capital T, it will just be C. So that means what you've done at time T0, you buy a portfolio phi, then you sell a portfolio C, then you realize an amount, you make a profit of C. You use that whole C to buy a zero coupon bond with maturity capital T. That means your transaction is actually zero because you have not made any profit, you have not made, so you have zero cost. So now for this investment period, or what you call the holding period, you have zero initial cost because here, this one, the profit that you realize is what you use to buy zero coupon bond. So now at time capital T, your value of this portfolio will now be the value from T minus, because this is what you bought, is what you have, minus that, plus now the zero coupon bond that you bought at that particular, which will get to this. Of course, you can see because this one here is bigger than that, so that this one here is in particular bigger than C over D. And again, this one is positive. That means you're making money from nowhere because at small t, you have zero investment, but at capital T, you have something positive. And this is purely arbitrage. For there not to be arbitrage, that means this inequality cannot be true. That means we have to invest. So in an arbitrage-free market, we must have the value at any particular of this strategy must be bigger or equal to the value from the strategy C for any time between 0 and capital T, which is your holding period or investment period. Okay, and so that's how we prove this arbitrage inequality. Okay, are we together? Okay, now we come to arbitrage inequality for calls and put. Again, if we have to go through what's a call option, or what in general, what's the put, what's an option? An option is the one that gives you the right, but not the obligation to buy or sell an asset in the near future, or the underlying instrument in the near future at some price, then that price is called the strike price. If we use these notations, and please let's not make sure that we understand. So this is the call value at time small time, any instant time t, with maturity capital T, and a strike price is K. That means this is the price that of a call price of a call option that will give you the right to buy an underlying at maturity capital T, but you are buying the underlying at price K. And this one also analogous to what is this? It means it's the price of the put, European put with maturity capital T, and a strike price, which is K. Meaning it will allow you to sell. This is the value of the put option that will allow you to sell an underlying for strike K at price K at maturity capital T. So these are the values of the options. And here, this one here, if we denote C capital T, is of course different from this notation. These are the payoff. This is the payoff of a call option. And here, a plus is just the maximum of this and 0. And this is the payoff for the put option or the put option. Okay, so here I just want to make sure that we distinguish between the value of the call or options as well as the value of the payoff. Okay, and here I'll say again, if you look at the call price, this is the call price, European call option with maturity capital T and a strike price K, and this is the price of the put option with maturity capital T and a strike price K. And then if you look at, this is the diagram for the call option. A call option is a decreasing function of the strike price. So the more the strike price increase, the call option value decrease. It's a monotonic decreasing function of the strike price. Okay. And again, we have some of the inequalities. These are the inequalities for the call and the put options. If this is your underlying asset at times small t minus the discounted value of your strike price, if you multiply K by D, it means it's a discounted value of your strike price. This plot here must always be less than your call price at times capital T, at times T with maturity capital T and strike K. And this is always less than the underlying price at that particular small time T. And this is the inequality that one has to prove. And also the next one is that if you take the discount factor with maturity capital T at times small t minus S, this plus must be less than the put price at small t with maturity capital T, and this is always less than K. And this is what we said, that if T2 is bigger than T1, then of course we have then a call price is an increasing function of the maturity, given that if, then that means this price at T2 must be bigger than the price at T1 if T2 is bigger than T1. So and then the next one is the value of a call decreases with the value of the strike. And this is what we have seen from the previous figure. Okay. And now that means if you have the strike price, K1 is less than K2, then you have the discounted value of the difference in the strike price is less than the difference in your call prices, given that T is constant. And another inequality is that the value of the call is a convex function of its strike. That means if you have two strike price, K1 less than K2, then for any alpha between 0 and 1, you are given that the value of your call price with maturity capital T and the strike price given in this form, which means it's a convex in a strike, it can be, it's less than alpha times the value of the call price with strike K1 plus 1 minus alpha times the value of your call price with strike K, given that the maturity are the same. Okay. Of course, for the all these one are really pretty simple. Okay. I think all these inequalities are very simple to prove them, but we're not going to spend more time trying to prove it, just to highlight to you that these are some of the inequalities for the option, especially the call and the put. Okay. To show the inequalities, so for instance, to show the first one here, to show that ST minus the discount value of your strike price is less than this. What you do, you have two investment strategies. One is phi and one is C. So what you do, you buy 1 unit of the asset S at time small t, and then you hold it up until maturity. So that means the value at maturity, if you buy 1 unit of S at time small t, at maturity, the value will be S capital T. And then for phi, you buy, so these are two investment strategies. One investment strategy is just where you buy the underlying. And then the other investment strategy, you buy one call option. In this case, the value of the call option is equal to here, and then you hold it until maturity. That means at maturity, because you have bought a call, then you can now be able to buy the underlying at this, and this is your payoff. Right. So now, so since you are given that your strike is always a positive number, then you are given that this one here, ST minus K plus is always less than ST. Of course, because this one here is a positive number, this minus that must be less than that. So that means the value of your self-financing strategy phi must be bigger than the value of the self-financing strategy C. This one here, of course. So that means the value of a call option must be less than the value of your underlying. So where does this come from? This comes from the other theorem, that inequality that we've proven. Otherwise, there will be arbitrage. These are self-financing strategies that if one portfolio or one strategy has a bigger value at maturity than the other strategy, that means at the initial point, the value from this strategy must also be less than the value from the second strategy. Otherwise, this arbitrage opportunity. Okay, so of course, then you can see that CT, the value of the call price is less than S. So we have proven this. To prove this one here, again, it's very simple. To show that ST minus the present value of your strike. So what you do, you compare two strategies. One strategy is phi and the other one is C. Where here you buy 1 unit of stock and then you you issue a 0 coupon bond so that at maturity with a notional amount of K, So now in this case, because you bought 1 unit of S, that means the value at time T, you have S. Because you issue a zero coupon bond with a notional amount of K, so this means your value in that, the value at maturity of this investment strategy phi will be ST minus K. Okay, that's okay. So now you buy 1 unit of S and issue a zero coupon bond. Again, I repeat it here. That meaning at maturity time, you have S capital T because of this coming from the underline, and this is because you have issued a zero coupon bond with a notional amount of K. Then another strategy, you buy 1 call with a price C and hold it. Then that means the value of that strategy at maturity will be ST minus K plus. And this is the gain, this is again derived from the payoff of a call option. And again, because here, this strategy here can become negative. Because if K is too large, then this can become negative, while this strategy C, you have a call option, the value can either be 0 or positive. From here, right? We can see from here. This one, if K is so big, is so large, then this value can become negative. Now in that case, so we can see that the value of this strategy is bigger than or equal to the value of the second strategy. So that means we can derive, because this is what we get, the value of the call option must be bigger than this, the present value at initial. Because this initial value, because if you look, this is what you have at maturity, meaning at initial value, you have ST minus the present value, because at maturity, you have issued a zero coupon bond with a notional amount of K. That means if you bring it back to today, you're going to have the discounted value of the strike. And this is what you have here. And this is what you have proven. So since now, this one is bigger or equal to 0, the value of the call price is always positive. We know that this here must be bigger than the max of ST minus, and this actually proves this inequality here, or this side. And again, you can prove these things in the same way, or the other inequality that we have shown it here, just in the same way, but really, really simple as well. And here, here I tried now to show that let K1 equal to be bigger than K2. So now that means S minus K1 must be bigger than S minus K. Of course, because K1 is less than K2. So that means here we can, you can also, this inequality here can also be true. So for strategies, now what you do, you always come up with 2 strategies, and then you buy the one which is cheaper, then you sell the one which is more expensive, meaning you buy the one with a cheaper strike, and then you sell the one with a higher strike, and then now the value of this will be, the value of this strategy will now be the difference in the cost, and then the values of a time capital T, because these are call, this from call with strike K1, this is from, because you are selling a call with strike K2, and then in this case, meaning the final value of ST now in this case will be, of course, less than 0, because this is the maximum between ST and minus K, and also minus this, which means this one here must be less than K1 or K2 minus K1. And this again just proves this inequality here. Okay, And because now, if you want to discount it back to today, then you can use it. And then you also consider the strategy 5, because always what you do to prove this, you consider 2 strategy C and or what you call the self-financing strategy 5 and C, and then you work throughout to see which one is cheaper. So now in this strategy, what you do, you buy a 0 coupon bond with a notional amount of K2 minus K1 at maturity. So that means if you want to find what is this value now, you have to discount it back to time T. And this is what you find. This is the value of this financing strategy C at time T. And this is what you do. You find the difference and then you discount it. So you see that these 2 strategies that you discussed, the first one strategy and the second self-financing strategy, they are all both buy and hold strategy in such a way that the phi at capital T, the value of that is always less than the value of phi of C at capital T by no arbitrage, or by what we call a principle of no arbitrage. That means the value at initial for this strategy must be less than the value of the from the strategy C at time T. And then now you just say, okay, well, at time T, a small t, the value of this strategy is that one, must be less than the value of what from strategy C, which means this value here. And then you are pretty much done. Yes, so now here we just note that the derivatives of this inequality does not involve an assumption on the probability of F. And this one here is the discount factor at time T for maturity capital T. It's a discount factor associated to the interest rate at which the market maker can lend or borrow. And to prove each inequality, you have to compare 2 static strategy, what we call the self-financing strategies. In this case, we consider phi as well as C. Okay, and again, in the arbitrage free market, and this is now leading to what we call, or what is mostly common in the, one of the topical inequality, what we call the put call parity. And this is what we're going to discuss next. Okay. In a nutshell, last week, we discussed what we call the law of one price. The law of one price, again, you compare 2 investment strategies. Then you say, if these 2 investment strategies have the same value at time 0 or at any time T, and have different, they cannot, there's no way they can have different value at some other times. If that's happened, then there's arbitrage opportunity. And this is what the law of one price means. It means that if 2 strategies, phi and C, are 2 self-financing strategies in an arbitrage-free market, then if at some date, capital T, they have the same value, meaning the values which are denoted by V at capital time T for this strategy is the same, and the probability of this value to be the same is almost surely, then we are guaranteed that at initial point or at any other times, they must have the same value. Otherwise, there's arbitrage opportunity. Okay, then how do you prove that? okay, if at some point small t, these values are the same, okay, then you just assume that they have the same value, then you can constitute up a portfolio that have a zero investment. So now you have phi 1 minus C1 up to say phi n, and this again is minus phi n. So the initial profit in this case is going to be okay. Again, you prove it. Sorry, I think I made a mistake here. Supposed to say this is less than. Then in this case, you are going to have more profit here, which is pi. And then from now, if you have a holding period, say from T to capital T, then what can you do? You can have another self-financing strategy N or eta, which is given as a difference between these two self-financing strategies. Then, of course, you are guaranteed that your final profit here is equal to the difference in the, but the difference here is equal to 0. Then that means you have a profit of pi, which is with probability 1. And then in this case, also, you see that you have started with two strategies, but they must have you realizing some profit at maturity, and this must be an arbitrage opportunity. And this is when you're proving that no, you cannot have two self-financing strategies that have the same final value, but at some other points before maturities, the values are different. You cannot. Okay, then we come to, okay, so this is the value of the call price at times small t, and then we come, this is now what we call the put call parity. We're going into that discussion now. So now if S does not pay dividend during the life of an option, the call price or the put price, again, I think I must, there is a mistake here. This must be a minus. The call minus the put must be equal to S minus that. So that means the call minus the put must be equal to the underlying spot price minus the discounted value of the strike. Okay, so if S pays dividend, and then again, the call price minus the put price must be equal to the spot price of the underlying minus the discounted value of the strike price minus the dividend. Okay, so this is what we call the put call parity, and this is one of the most important relationships in between the options as well as the underlying in financial mathematics. And then to prove it, you use two strategies, self-financing strategies, and then you show that, okay, I'll sketch the proof again. I'm not going to go through the proof, but I'll just sketch it. So what you do, you construct up two financing strategies. You show that these two strategies have the same value at maturity. Then by law of one price, these two strategies must have the same value at any other arbitral time t. And this is what you do. You consider phi, we consider phi, where you buy a call price and then you sell a put of strike K. Now, in this case, your value at any small t is going to be this, and the value at your maturity is going to be ST minus K. Okay? Then you consider another self-financing strategy, which is C, where you buy a zero coupon bond with a notional amount of K, with maturity, and then you also buy 1 unit of the underlying asset, meaning at time T, the value of that strategy will be ST minus K, but because you are taking the value back to today of the notional amount for the 0.1, that's why you have to discount it. Then, what is the value of this strategy at capital T? Because now this would be capital T minus K. Then if you put D, then you here now become capital T. This become 1, and this is why you have K here. If you compare this value at maturity, VK of C is the same as the value of at capital, meaning these two strategies have the same value at maturity. Then by law of one price, meaning this value here must be equal to this value there. And then you come up with what you call the put-call parity. And again, I think I have a typo here. This must be a minus. Okay. And that concludes our lecture on investment strategies and how to prove the most important inequalities in the financial mathematics. Okay, let me see if there are questions. If there are no, okay, let me see. Okay, I'm going to share another slide for another lecture. I hope can anyone see my slides? I think there was a problem with slides. Okay. Great. Okay. In the next lecture, I'm going to. Okay, so in this lecture, I'm going to. So this is it was again for those who just came in. This is supposed to be next week lecture, but because I'm attending a conference next week, I've decided to give this lecture today in order to complete a set of lecture series that I prepare for this mini school on the introduction to quantitative finance. And in this lecture, I'm now going to give you the most basic or most important ingredients of the financial mathematics or the mathematics in finance. So in this case, I'm following the book, Arbitrage Theory in Continuous Time by Thomas Bjork, and it's about arbitrage pricing. Okay. Yes, so it's called the arbitrage price. And this is what we're going to look at, to pricing of derivatives using arbitrage theory. Okay, so we're going to go through arbitrage theory for pricing of forward contracts. So again, if you recall, a forward contract is we show that the value of a forward contract on S with a strike K at maturity capital T can be replicated by a self-financing portfolio. How did we do? So you borrowed S dollar at time T, and then buy 1 unit of asset, and then pay back the loan at capital T because you borrow money. And the gain in that strategy is exactly the same, which is supposed to be the payoff of a forward contract. And that what you just have worked out there is called the replicating strategy. And now in this case, a self-financing portfolio which generates exactly the same cash flow as a given derivative contract is what we call a replicating strategy. It's a self-financing portfolio which generates exactly the same cash flow. And this is what we're going to go through now. Okay, so in an arbitrage-free market, meaning you in a market where there's no arbitrage, the value of a contract should be equal to the value of any replicating strategy. So that means the principle of arbitrage pricing principle, meaning is finding a self-financing strategy phi, which replicates the cash flow of this payoff at maturity, meaning this is the value of your strategy. It replicates the probability of this be equal is almost surely it's 1. By absence of arbitrage, the value of your payoff at any small time less than capital T must be equal because they replicate the value of your self-financing strategy. And this is when you have in an arbitrage-free market, the price must be equal to the cost of the replication. Does this only work for forward contract? No, it can also work for put or other derivatives like put options and so forth. Okay, let's look at the simplest model for modeling the market uncertainty. So we consider a simplest model of market uncertainty, which means it's 1 period, 2 states market. So suppose this is a time at the present time, and this is some time in the future. What you want to do is that we know the value of your underlying assets today, but definitely we don't know what is the value at this capital T. So we are given the real-world probability that this underlying will go up by this percentage U, and then this probability of going up now is P, it's probability, and this is the probability of going down is 1 minus P, and the percentage of going down in this case is D. And then we know that U is always bigger than 1 and D is less than 1. So you consider a market, 2 trading days. One is now, which normally says small t is equal to 0. And we also have the capital T, which is the maturity. We also consider a risky asset security, which is denoted by S, and the value of this at time 0 is denoted by S0. Investor who can borrow or lend at annual rate, meaning if you put money, if you put R1 in the bank account, at some other mature earning interest rate at R, simple or annual interest rate, then in your bank account at this this date, you are going to have 1 plus R to the power of T. Okay, are we together? So now the discount factor in this case, you can give it like 1 over 1 plus R to the power of T. So why do we say market uncertainty, we say a market is uncertain because your XT is random variable with two states. The probability of going up is P, the probability of going down is 1 minus P. Okay, which is that. Meaning in this, we say, okay, short selling is allowed or shorting is allowed, meaning you can sell something that you don't own at a particular time. So now you consider two portfolio. I mean, you consider a portfolio, only one, but it has two investment in two securities. One is the risky, and then one is the riskless asset. So we say 5-0 is the one holding a cash holding, which means you put in a riskless bank account, you put this much, and then 5-1 is the unit of investment in a risky asset or security. Then the value of that strategy at time 0 is 5-1 times S0 plus 5-0, because 5-0 because you put $1 or R1 in the bank account at time 0. But the value of this strategy at capital T here will now be equal to 5-1, the units in a risky asset, plus the units in a riskless account or bank account. Now, if you put R1 in the bank account, earning interest rate annual at R, now this is what's going to have in the bank account. So the value will now be equal to the investment in a risky asset plus the investment in a riskless asset. So that's the value. So now you have this one at initial point, but at maturity, you can either have this one here, what you have in the bank account, plus either when the asset goes up and when the asset goes down, these two, with this probability. And again, this P and 1 minus P are probability of going up and down, but these are real world probability. Okay, so we have only one period. All portfolios are what we call so arbitrage strategy is what we call phi, is an arbitrage strategy. Then you have, if you say something is an arbitrage strategy, it means the initial investment is equal to 0. Okay, meaning the value at time 0 must be equal to 0. If you set this equal to 0, and then the value at maturity is positive. So that's, in a nutshell, that's how we define the arbitrage strategy, right? We say it costs you 0 investment, but at the maturity, at capital, you are guaranteed that this has positive value. So now we should go through. If you set this one equal to 0, then you solve this equation, then you end up with 5-0 is equal to 5-0. Then you have something positive. Then you can say 5-0 is equal to minus 5-1 S1. Then if you put this value here into this other two equations, then you end up with this inequality. Here, just put it in here, then you simplify. Then you end up with these two inequalities. Then a question is, can these two inequalities be satisfied simultaneously? That's what we want to do, right? these two inequalities, right? And case one, what if D, the percentage of going up is bigger than U, which is means say less than U, less than 1 plus T, then for any phi, we'll satisfy those two inequalities. That means what you can do, that means the stock return is always less than the interest rate. That means what you do, if your interest rate is higher, then you can actually just invest money in the bank account, and then you sell a stock in this case. Okay. Another case is, what if U is bigger than D, bigger than 1 plus R to the power of T? That means the stock return is bigger than the interest rate. Now, in this case, you borrow money from the bank, then you buy the stock so that you can. So now the arbitrage strategy, you borrow money, you buy the stock, and then sell at time T, and then you have a gain. And again, all these two, in these two cases, you are making money for nothing, from nothing. So what if you have U bigger than 1 plus R to the power T, which is bigger than D? So now these two inequality cannot be satisfied simultaneously. Now in that case, so there is no arbitrage. So for there not to be arbitrage, we must make sure that U is bigger than the value of your in the bank account, which must be bigger than, meaning this inequality is satisfied. And that is arbitrage-free market. And this is what we're going to work with. Okay, then we look at what we call a replicating portfolio. A replicating portfolio, now we're now going to look at an arbitrage payoff. Suppose we have a payoff, say H, and the underlying asset at time capital T is S as a function of capital T. So the value at time small now today is S0, and then it goes up with the U percentage, and then so these are your payoff. The payoff in this case is denoted by HU, meaning it's in the up state, and then the payoff in your down state is what is denoted by HD. So now a replicating portfolio, again, we go back again to the formal definition. It's a portfolio phi which has two investments. One may be in a risky security and one is in a riskless security, like a bank account, whose payoff at capital T matches the payoff of the derivatives, meaning it matches the payoff. This is the value of your trading or replicating strategy, and this is the payoff, meaning the probability of this one is almost sure. Okay. Then, if you look at the example that we have done, this example here, then you can see the value of this replicating strategy at maturity was equal to the investment in a riskless account, bank account, plus the value in your risky account. So now this one here lead to another two equations. If you look at these two equations here, so you have this one here is the payoff in the up state, and this is the payoff in a down state, meaning you say this one here must be equal to HU, and this one here must be equal to HD. Then this is 4 for the replicating right. Then what we can do is to solve. If you subtract equation 1 minus this, then you can make phi 1 the subject of the formula, and you end up with phi 1, meaning the number of investment in the risky security must be equal to this. If you take now this and put it in the first equation, or maybe in the second equation, then you end up with phi 0 to be equal to the discounted value of this quantity, meaning this is how much you're putting in a bank account. So you have phi 1 shares plus phi 0 in a bank account, has a payoff. Okay, this is a payoff at maturity, this is a payoff at maturity in an upstate and downstate. Now you want to make sure what we're interested in. We're interested in calculating what is H0, what is the value at initial time small t equal to 0. Okay. Now, so this model, any derivative contract can be replicated, whether it's a call, a put, or maybe a forward contract. But we'll come to that later. Okay, so what we have done so far, we found out that we can, this is the number of unit in a risky, and this is an amount of unit in a bank account. Now, by replicating, so what we're interested in really is we want to find what is the value of this replicating portfolio or this payoff at time 0. Okay, so now what you do, you say by the no arbitrage principle, we say that the value must be equal to phi 0 plus phi 1 times S0. So this is what we have looked at already. Yeah, so this one here, times 0, right? But now we just need to make sure that we know what is this value, phi 0 and phi 1. Okay? And then if you put it in that equations, if you put in now these values, and then you end up with this. So that means if you do it like that, then you can just say the value of an option must be equal to the discounted value. If we just simplify this properly, the discounted value of P times your payoff in the upstate plus 1 minus P times the payoff at maturity. But, and again, this is very important because the P, this P is different from the real world probability, this one here. And this is what makes a difference. That meaning this is sort of like the value of an option is a discounted value of a risk neutral payoff. And this is what we're going to discuss next. The price of a contract with a payoff HU and HD, please make sure this is not the same as discounted value of a payoff, because that payoff here is discounted with new probability P, which are risk neutral probability, and then we're heading there now. Okay, so the value is equal to this plus that, meaning the value of any derivative with payoff H must be equal to the cost of replicating H, which is equal to the value at time T, which is equal to 0 of a replicating portfolio. Now, in arbitrage pricing, whenever it's possible to exhibit a portfolio, which means a replicating portfolio, the value that replicates the payoff must be equal to the value of a replicating strategy. And this is what now we call it arbitrage principle. And again, you can verify if you just solve what is phi 1 and phi 0, that you input the value of your call price must be equal to this. Okay, well, before we go to risk neutral probability and so forth, I just want to give a simple example of a call option. How do you do the replication of a call option with maturity capital T equal to 1? And you have the strike price, which is K equal to 100. Again, if we go back to the basics, so a call option is a derivative contract that allows or gives you the right to buy an underlying asset. At maturity, in this case, is T equal to 1 year. You are going to buy the underlying at 100. Okay, so now you construct up a hedging strategy that have two investments. One investment is phi 0 in your riskless account or riskless asset, and phi 1 to be in a risky asset. So now you construct up, because here today the underlying asset is 100, it goes up, and then in up state is always 101, and then here it goes down to be 99. So now if you want to find what is the payoff, what is the HU and HT, because the payoff, this is a call option, the payoff would be 101 minus K, which is 100, it's just going to be 1, while here it's going to be 99 minus 100, but because 99 is less than 100, so we're only going to take 0, because it takes the maximum between ST minus K and 0. So in this case, we take 0. So the replicating portfolio, in this case, because you have the value of the assets now here is going to be 101, then you multiply it by phi 1. That's why we have here. If this interest rate, if you invest one rent at 5% per annum, and so now you're going to have, at this point, you are going to have 1.05. You multiply it by how much units in a riskless bank account. This replicating portfolio must replicate the value of your derivative, meaning it must be equal to 1. And then in this case, you do the same. It will be 99 because the value of the asset at this in the down state is 99, multiplied by phi 1, because that's the investment in the risky security, plus what you have in the bank account, which is the same, must replicate the value of the option. And then this is equal to 0. So you solve these two equations, and then you get that the value for phi 1 is 0.5, and then phi 0 is equal to this. So now, what you can do, if it's a minus, it means you sell, and then if it's okay, what you can say, you can borrow money, or then you can buy. So what you can option seller can do, you can have a holding of 0.5 share of each call option, and then you borrow this amount of money. Then again, if you check properly, the percentage you see if R is 0.05, this inequality is satisfied so that you have an arbitrage-free market. So now in this case, the value at this time t equal to 0 at this particular time must be equal to phi 0 plus phi 1 times S0. Now in this case, this is the value of a call option. And this is how you price a call option, really. Okay, if we are in arbitrage free market. Okay. Now, in particular, in this model, the value of an option does not depend on a forecast probability of scenarios. A market participant with different views forecast regarding probability of scenario will still agree on the value of an option, and this is what we call the risk neutral probability, and this is what you're going to discuss now. Okay, risk adjusted probability, and this is really now coming to differ with what we already discussed with actuarial science pricing, and because now we use risk adjusted probability measure. So if you look at the value of a derivative at time 0 must be equal to the unit that you investing in the risky security plus that, then you just add this two, because this you already derived the equations. And if you put everything together, this is going to be the discounted value of what we call HU times Q, and this, I think I've already brought it somewhere. Yes, HP, and I really wanted to make sure that we all understand that this P is not the same as a risk, as a real world probability measure, otherwise we make a big mistake. So that we have to do risk adjusted probability. So we calculate what is QU, a risk neutral probability of going up, and this is the risk neutral probability of going down. And this is how you calculate this probability. And then we are in an arbitrage free market. The value of the derivatives must be equal to the discounted value of your payoff with risk adjusted probability. And this is how you calculate that risk neutral probability. And this is how this valuation of financial mathematics or mathematical finance differs from the valuation in actuarial science. Okay, we are given that if the risk neutral probability of going up plus the risk neutral probability of going down must be equal to 1, and this probability are always positive, and this is how you value a derivatives using no arbitrage theory. So it means the value of a derivative is a discounted payoff using risk neutral probability measure. And now we call this probability the risk neutral probability or the implied probability of the scenario. Okay. So now that means we have shown that if we weight the scenarios with these probabilities, say Q, U, and D, and the value, so sometimes of this payoff is a discounted value at time 0, where you have your risk neutral probability. So sometimes we say it's the expected value under an equivalent martingale measure of this payoff, where the payoff here is given like this. Meaning an arbitrage free price of a derivative is equal to the cost of the hedging of this derivative, and This means the discounted expectation of the payoff using risk-adjusted probability. You don't use the real-world probability in calculating the payoff. And that's what we call the risk-neutral valuations in financial mathematics. And again, here it means the risk-neutral probability of going off for the upstate does not depend on the payoff, and also the risk-neutral probability in the upstate does not depend on P, but only depends on UD. P again was the real-world probability measure, or the real-world probability. And then now the arbitrage-free price of a NIT payoff, this is the discounted value of your payoff using risk-neutral probability or risk-adjusted probability. And this really concludes the important aspect of financial mathematics. And this is how we can now compute the derivatives price, the price of the derivatives. So it can get more complicated than here when you just consider a binomial, which is a discrete case. When you now goes to like a continuous continuous distributions, then what we want to do is to compute the payoff of a stochastic process, or a process that we don't, maybe depending on a continuous distribution. And the first the first valuation of the continuous time for the derivative price was now due to Black-Scholes and Melton model in the 1973, who assumed that the underlying process follow a geometric Brownian motion, and they compute the analytic price for a call price on warrant options. And this was the birth of mathematics of finance. And this is the great deal, is actually to evaluate or to compute this expectation. And I think I'll stop here. Any question?